Hello everyone. Now we are starting valuation of bonds and calculation of YTM, yield to maturity. So this is a numerical topic, practical topic, expected some numerical question will come. So let's start with the bond valuation. Assuming that we now know how to use time value of money, how to use this financial calculator, and we know about the cash flows related to bond, different type of bonds. So किस तरीके से अब हम इस बॉन्ड को वैल्यू करेंगे, हम यही डिस्कस करने वाले हैं। वैल्यूएशन करने का स्ट्रेट फॉरवर्ड तरीका एक ही है, दैट इज आप किसी भी एसेट का अगर आप वैल्यूएशन करना चाहते हो तो आपको क्या करना है, उस कैश फ्लो से जो फ्यूचर एक्सपेक्टेड कैश फ्लोज आने वाले हैं उस एसेट के, उनको उस आपके इन्वेस्टर की डिस्काउंटिंग रेट, रिक्वायर्ड रेट, डिपेंडिंग ऑन विच विल बी डिपेंडिंग ऑन दी रिस्क प्रोफाइल ऑफ दैट एसेट, उस डिस्काउंटिंग रेट से, उसकी एक्सपेक्टेड रिक्वायरमेंट से आपको क्या करना है, उन कैश फ्लोज को डिस्काउंट करना है। उनको प्रेजेंट वैल्यू पे लाके जब आप सम अप करेंगे, दैट समेशन इज द वैल्यूएशन ऑफ दैट एसेट। और इस टेक्निक को हम क्या बोलते हैं, डिस्काउंटेड कैश फ्लो टेक्निक, डीसीएफ टेक्निक। तो बॉन्ड वैल्यूएशन में भी हम डीसीएफ टेक्निक ही यूज कर रहे हैं। जैसे हम किसी एसेट को वैल्यू कर रहे हैं, सेम बेसिस पे हम बॉन्ड को भी वैल्यू ही करने वाले हैं। यानी यहां पर भी हम बॉन्ड के फ्यूचर एक्सपेक्टेड कैश फ्लोज यानी कि कूपन और उसके रिडम्पशन वैल्यू को हम अपने इन्वेस्टर की रिक्वायर्ड रेट, डिजायर्ड रेट से क्या करने वाले हैं, या डिजायर्ड यील्ड से क्या करने वाले हैं, डिस्काउंट करने वाले हैं। नाउ इन्वेस्टर ये डिजायर्ड यील्ड कैसे डिसाइड करेगा, डिपेंडिंग ऑन द रिस्क प्रोफाइल ऑफ दैट एसेट, दैट रिस्क प्रोफाइल ऑफ दैट बॉन्ड। इसमें वो क्रेडिट रेटिंग एजेंसी इसकी क्रेडिट रेटिंग का भी हेल्प ले सकता है और अपने खुद के फाइनेंशियल एनालिसिस का भी हेल्प ले सकता है। So use how a bond will be valued, it is going to be valued using the DCF technique, discounted cash flow technique, DCF technique। कैसे वैल्यू करेंगे, कुछ एग्जाम्पल ले लेते हैं, कुछ हम फिक्स कूपन पेइंग बॉन्ड्स के एग्जाम्पल ले लेते हैं और जीरो कूपन बॉन्ड के एग्जाम्पल ले लेते हैं। परपेचुअल बॉन्ड भी ले सकते हैं, अमोर्टाइजिंग बॉन्ड भी ले सकते हैं, डिफरेंट बॉन्ड है बट फॉर्मूला एक ही रहेगा। दैट इज क्या करना है, आपको अपने बॉन्ड से आने वाले फ्यूचर कैश फ्लो इन द फॉर्म ऑफ कूपन, दैट इज PMT, that is the annuity what you are going to get, and the future value, that is the redemption value, उसको आपको डिस्काउंट करना है आपके रिक्वायर्ड यील्ड, डिजायर्ड यील्ड से। रिक्वायर्ड यील्ड और दी डिजायर्ड यील्ड से आपको क्या करना है, डिस्काउंट करना है। सो लेट्स गो फॉर सम वैल्यूएशन। वैल्यूएशन ऑफ बॉन्ड्स, हमारे पास में एक 10% सेमी एनुअल बॉन्ड ऑफ फेस वैल्यू और पार वैल्यू of rupees 1000 is there, or we'll go for two type of bond, annual and semi-annual, that will be better. We'll cover annual, semi-annual, Z bond, perpetual bond and amortizing. Let's go for valuation of 5 different type of bonds. Let's do the valuation of all 5 different type of bonds. So it's a 10% coupon paying bond. 10% coupon paying bond of a face value of 1000 rupees and a tenure of or term to maturity of how much? 4 years. Now it will be redeemed at redemption prices, assuming it is equals to redeeming at par value, which is equals to 1000. If it is not redeeming at par value, some relationship will not hold, which we are going to generate here. So assuming that it is going to be redeemed at par. Next, now let's go for the first bond where the frequency and our investors desired rate of return or desired yield is equals to, let's say, case 1, B and C. Let's say the desired rate is equals to 8%, desired rate is equals to 10% and desired rate is equals to 12%. So we are going for 3 different cases where as per the risk profile, investor is only asking 8%, second case investor is asking 10% and then 12% if because higher risk is there. So how to value this? Let's go for first valuation. If it is an annual coupon paying bond, so if we draw a time series T0, 1, 2, 3 and 4, 4-year bond, annual series, investor is valuing bond at T0, the present value, and he is going to receive how much? 10% coupon is going to generate 100 rupees, 100 rupees, 100 rupees, 100 plus 1000. So these are the future expected cash flows from the bond, assuming the issuer is going to pay or meet its obligation on the due dates. So now what we are going to do, we are going to discount these bonds to present T0. So your present value is equals to 100 divided by 1.08 case A plus 100 divided by 1.08 square till 100 divided by 1.084, or I'll put that also 100 divided by 1.08 cube plus 1000 divided by 1.08 power 4. So how we are going to value this? So we have n equals to 4, we have IY, the discounting rate, equals to 8%, we have PMT equals to 100 and we have future value equals to 1000. So we can compute our present value, which will be equals to 4, 800 PMT and 1000 as my future value. So present value comes to be negative 1066.2424. So it means this bond is having a value of 1066.24. We are assuming here 2 things. Number 1, that this bond we are doing valuation on the coupon payment date. So this valuation, whatever we are doing, this valuation we are doing on coupon payment date, that is not between the 2 coupon payment dates. Otherwise there will be effect of accrued interest that we will cover in the next part. So its valuation is done on coupon payment date. We are doing this valuation with this assumption. Next, so valuation of this bond, if the required yield is equals to 8%, will be equals to 1060. So it means bond is trading at premium to par. So now this bond will be trading at premium. Number 2, case 2. So if I go for case B, my present value will be equals to, in this case the only change will be equals to my discounting rate 100 over 1.10 till 100 over 1.10 power 4 and 1000 over 1.10 power 4. This is going to give us value equals to, let's see, 100, 1000, 10, 4 and present value, it is giving us 1000 rupees only. So it means bond is trading at par. So we can conclude here that if the coupon rate 10% is equals to your desired yield and bond is going to be redeemed at par, there is no premium on redemption. So in that case, your bond will be having a fundamental value of 1000 rupees. It will trade at a par. But if your desired yield is less than your coupon rate, bond is going to trade at premium. Number C, let's go for the third calculation, case C. And in that case, your N is equals to 4, IY is equals to 12, PMT is equals to 100. Now we are having desired yield greater than the coupon rate. Then in this case, what will be the present value? Let's see, this is going to be 939.25. So it will be 939.25 will be your present value. We'll ignore the negative sign because calculator is going to give us data in inflow and outflow format. So in that case, calculator is assuming that bond is going to generate an inflow of 100, 100, 100, 100 at T1 to 4 and 1000 at T4. So you have to do outflow for purchasing that bond, which is going to be 939. That is why it is coming as negative. So we can conclude here from these three calculations that if number one, if redemption value is at condition, redemption value is at par value, and if your coupon rate is greater than your desired yield, or first less than your desired yield, A case of investor, so bond will trade at premium. Second, if coupon rate is equals to desired yield, in that case bond will trade at par. And C case, where coupon rate is greater than your, reverse. First case is where coupon rate is 10% and desired yield is 8%. And the last one is where coupon rate is 10% and the desired yield is 12%. Bond will trade at discount to face value. So with these three calculations, now we know that whenever there will be coupon higher than the desired rate and bond is redeeming at par, then it will trade at coupon rate is higher than the desired rate, then bond will be trading at premium to the face value. So let's go for semi-annual, how the calculation will change. Then in that case, the series of 4 year will convert into 8 semi-annuals. So in that case, if it is a semi-annual series, if it is a semi-annual bond, then in that case your N will become 8, your discounting rate will become half, and your PMT, your coupon, will become also half. It's equals to 60. Your face value or the par value, redemption value will be same. So let's go for the valuation again. Case A, your desired yield in case A is equals to how much? 8%. So in that case, R will become 4%. Your discounting rate will be half because now you are having T0, T1 till T4, 7 and T8. This is semi-annual series. And now you are valuing at T0 where you are receiving 50 at the end of each year along with your redemption amount of par value. So now again, what will be your, so IY is your 4%. Let's put these values and compute the present value. So present value is equals to, or I'll go for the first equation. Present value is equals to 50 over 1.04 till 50 over 1.04 to the power 8 and 1000 upon 1.04 to the power 8. So let's go for this value. First, 50 is my coupon, 1000 is my redemption value, 4 is my discounting, and N is my 8, that is 8 periods. So present value is equals to 1067.33. So it is 1067.33. Again, the bond is trading at premium because coupon rate is now still greater than the desired yield. Now second, why there is a difference between the annual valuation of 1066 and 1067 semi-annual valuation? Because of the impact of cascading effect of compounding. Because in case of 4-year bond, there is a compounding for 4 periods, whereas in case of semi-annual bond, there is a compounding for 8 periods, so the interest effect is higher. That is why the value is coming as higher value. So let's go for next bond, that is zero coupon bond. If it is a zero coupon bond, then what will happen? So now in case of zero coupon bond, very important. Again, how to value zero coupon bond? So there is no coupon, so PMT is equals to 0. Face value will be equals to 1000. Number of year is equals to 4. Again, if the discounting rate is I, Y is equals to your yield, desired yield is equals to 8, 10 or 12, case A, case B and case C, we have present value equals to, if R is equals to 8%, R is equals to 10% and R is equals to 12%, what we are going to have? So present value will be equals to 1000 over 1.08 to the power 4. Only one cash flow standing at T4, fourth year end, we are bringing it to T0. Here present value will be equals to 1000 divided by 1.10 power 4. And here present value will be 1000 divided by 1.12 power 4. So let's calculate the values. Now we have 1000 as future value, 0 as PMT, 4 as my time. Let's put 8% in my IY in yield, desired yield. It is giving me a value of 735.03. If the desired yield is 10%, it will give me value of present value of 683. And if the desired yield is 12%, it will give me value of 635.52. 635.52. So in case of zero coupon bond, it will always trade at discount to face value. Why? In case we have positive yield, desired return requirement, then in that case it will always trade at discount to face value. So now question comes is that can a zero coupon bond trade at a premium to par value? Yes, there are certain extreme situations where your central bank is following a accommodative monetary policy and there is a lot of heavy supply of your money in the market. In that case, your government bonds sometime may trade at your premium to par value. So in that case, the desired yield will be negative. Very rare case, but it is a possible scenario where the monetary policy, because of the heavy supply of money in the market, the government of India, government bonds or sovereign bonds may trade at par to premium to the par value or face value. In that case, the desired yield of the investor will be negative. So we will cover in the second example when we are going to calculate yield, YTM, implied yield of generated by an investor by holding the bonds. So let's go for the zero coupon bond. We are done with this. Let's go for the fourth bond, a very important bond, perpetual bond. Again, now what do we mean by perpetual bond? Perpetual bond means the bond is having a tenure of infinite, or there is no finite tenure fixed. In that case, when you are company is issuing or issuer is issuing the bond, they are just going to pay coupon till infinite. So in that case, n is infinite, and infinite when cannot have we cannot input in the calculator. So let's find out if we can value or not. So if it is having a face value of 1000 and the coupon rate, your coupon rate is equals to 10%, so it means your annual coupon amount will be 100. So let's find out the valuation. Present value is equals to 100 divided by, if the desired yield is, let's say desired yield is 8%, so it will be 1.08 power 1 plus 100 divided by 1.08 power 2 till infinite. And we know that this is a constant cash flow series extending till infinite. With the formula of geometric progression, we know that the formula will become 100 divided by 0.08. So this bond is going to trade at 100 divided by 0.08, that is going to be 1250 rupees. The formula becomes PV equals to your PMT divided by your R, your desired yield. It's a perpetual constant cash flow series. So when we are calculating the present value of perpetual constant cash flow series, we can directly sum it up by dividing your constant cash flow with the discounting rate. So very easy formula. Now again depending on the desired yield, if desired yield is equals to 10%, then it will become 1000. If desired yield is equals to 12%, it will go below the 1000 rupees value. So in all cases, these rules that your redemption value, if the redemption value is equals to par, and your coupon rate, in all the cases where 10% is the coupon rate and desired yield is 8%, whether it's an annual bond, semi-annual bond, zero coupon bond does not have any coupon, so we will not consider this case here because zero coupon bond is having a zero coupon. In that case, desired yield is always greater than your coupon rate. And the fourth one is your perpetual bond. Again, your coupon rate is higher 10% and desired yield is 8%. The bond is trading at premium. Second case, let's say if it is a bond is trading, if the desired yield in this case is equals to 10%, then in that case your present value will become 100 divided by 0.10 equals to 1000, trading at par. Zero coupon bond again not applicable because the zero bond having coupon rate is equals to 0. But in case of semi-annual bond, again if we go for the B calculation, that is if we are going for discounting rate, R equals to IY equals to case B equals to 5%, because 10 divided by 2, it's a semi-annual bond. Your present value will come as, let's see what it will be the present value. 50 is my coupon rate, coupon amount. Desired yield 8%, PV 50. Okay, we have already on the first line. 50,000 is my redemption value. 8 is my number of cash flows. So if it is 4%, we have already done this, 1067 is the value. If it is 5%, the value will become 1000. And if in case of case C, if R equals to IY equals to 6%, 12% annual, so 6% semi-annual, it will give us a value of how much? 937.90. So PV will be 937.90. So again, when the coupon rate is equals to your desired yield, again the semi-annual is also trading at 1000 and the annual bond is also trading at 1000 at par. So second condition B is also satisfying. C case, where coupon rate is less than your desired yield, now zero coupon will be also covered because zero is always lower than any number of desired yield if it is positive. So C case, it is trading at discount. C case, it is trading at discount. Zero coupon in all cases, since desired yield is positive, it is trading at discount. And the last one, if let's say the desired yield is in this case R equals to 12%, we will have PV equals to 100 divided by 0.12 will give us 833.33. So in all, we concluded these three relationships, but this relationship only holds if the redemption value is equals to par value. If it is not, there is a premium on redemption, or if it is an amortizing bond, this relationship may not hold good. Now next is let's go for the second part, that is, now we are done with the first part, that is valuation of bonds. So we have done the DC, we have used DCF technique. What is market discount rate? It is the desired rate, required rate based on the risk of the bond, based on the risk of the bond. Next is equation of DCF, relationship. If the bond is redeeming at par, these three relationship will hold. Let's go for the next part, that is implied yield, or what is yield to maturity, that is what yield investor is expecting by purchasing a bond at a given market price. If the price is already available in the market, and if I say that I will purchase that bond at that price, what will be my return and what are the requirement for generating that return, means what are the assumption while calculating this YTM we are following, and these assumptions should be satisfied if we want to generate that return. So what is YTM? So yield to maturity is the internal rate of return, is the IRR, that is the implied return what you are going to generate by holding that bond. So how to calculate this bond? Again, we are calculating this with the assumption that this is done at the coupon payment date. So let's go for the calculation of YTM. Calculation of YTM, yield to maturity or implied yield. This is not desired yield. This is what he is going to generate. Desired is what he wants. Investor wants this much percent, and implied is how much he is going to generate. So let's go for a bond which is trading at the market value of this 10% coupon paying and semi-annual coupon paying bond. Semi-annual coupon paying bond with face value of rupees 1000 is trading at %, semi-annual coupon paying bond with a face value of 1000 rupees maturing in 4 years time. If it is trading at case A, rupees 1050, B rupees 1000, and C rupees 900. What is the yield to maturity or YTM? Now how to calculate it? Again, we are going to make a time series, and in this case we are having all the inflows and outflows which we will generate from purchasing this bond. Case A, we will go for an outflow of 1050 at T0, and then this will be a 8-pointer cash flow. Why? Because this is a semi-annual bond. So this is a semi-annual series, cash flow series, 4 years, semi-annual. So it is a 8-pointer cash flow series. So now T1 is your first half year, T2 is your first year ending, T3 is 1.5 year, and so on. So at the end of first half year, you are going to generate a coupon of how much? It's a 10%. You are going to generate 50 rupees, 50 rupees, 50, and so on till T5, 50 plus 1000. 50, 50, 50, and 50, and so on. So what is the implied return we are going to get? So in this case, we have 1050 equals to 50 divided by 1 plus r to the power 1, still 150, 1 plus r to the power 8 plus 1000 divided by 1 plus r to the power 8. So the equation is same. The only difference is, in the first calculation we were having desired yield and we were calculating What will be the fundamental value at which investor is ready to purchase that bond? Now here the market valuation is already given, and now we are calculating in a reverse order in that what return we will generate by purchasing this bond at this price and holding it till at the end of the tenure of the bond, that is till the maturity of the bond. So now again the same calculation, we now have PV equals to negative 1050. We have N equals to 8. We have PMT equals to 50 and the future value in positive inflow. Let's put the values. So 8, 50, 1000, 1050 negative as an outflow, and compute IY, that is yield, YTM is 4.2497. This is not annual. So annual YTM generated will be equals to 4.2497 multiplied by 2, that's going to be multiplied by 2. So we are getting a yield of 8 point almost 50% per annum. This is my yield to maturity, but this yield to maturity comes with certain assumptions. First assumption, what we have used here in this calculation, that we are going to, as an investor, we are going to hold this bond from the day one, from when we are purchasing till the maturity date. So we are not selling this bond in between the 4 years period, number one. Number two, whatever the promised cash flow by issuer, that every 6 month semi-annual basis he is going to pay 50 rupees and at the end he is going to pay 1000 rupees, he is not defaulting, since that means he is honoring all his obligations on the specified dates. And the third condition, very important condition, that these 50 rupees what we are receiving on T1 till T7, what we are going to do? We are not keeping this fund idle. We are going to reinvest this fund for the remaining tenure of the bond at the same YTM, that is 8.50. If it is not getting reinvested at same YTM, then the actual yield which we will generate at the end of 4th year will not be same. That we will cover in the risk part of the subject. So here we have got 3 assumptions. Number 1, we are holding bond till the maturity date. Number 2, all promised cash flows are paid on their scheduled date. And number 3, all intermediate inflows, this 50 rupees, 50 rupees, 50 rupees till T7 50 rupees is getting reinvested at this YTM. So this T1 50 rupees, what cash flow we have received on T1 will be reinvested for another 3.5 years, that is 7 semi-annuals at 8.5%. Then only this return will be realized. And in the reverse order, we can check if it is 8.5% yield, the price will be at the premium to par value, face value 1050. Second case where bond is trading at par. Let's see what will happen. So now we have PV equals to negative 1000, N8 again, PMT 50, FV is 1000. So let's find out IY equals to, let's see how much it is coming. -1000, -1000, 50, 8 and PV. So we got 5%. So annual YTM is equals to 10%. C case where PV is equals to how much? 900, -900 and 8, PMT is 50, future value is 1000. So we have IY equals to how much? Let's see. So 900 negative, 50, 1000 and 8 So we got a annualized semi-annual yield of 6.6522%. So annual YTM is equals to, multiplied by 2, we got annual YTM of 13.30%. So let's see what is there in the text part. So bond valuation we are done. It is the uniform annualized interest rate of future cash flow which are discounted at that rate, will the sum of that present value will be equals to price, actual price of the bond. So this is the implied return generated by investor, assuming investor is holding bond till maturity, he is not selling in between the period. Issuer is making no defaults, and last, investor is going to reinvest all intermediate cash flows at the same YTM. Now, can YTM be positive or negative? Yes, positive is possible. Positive we have already covered. So, can it be negative? Some cases, very extreme cases, when there is a excess supply of money, in that case YTM can be negative. Let's say example is, there is a GSEC, government security trading at GSEC, and it is a Z bond, GSEC Z bond. So there is no coupon, Z bond trading at premium. In that case it should be premium. So that's where then the bond will go below the par value. So trading at premium of 102 rupees, and it is having a par value of 100 rupees. So it will mature at this 100 rupees, and investor is paying 102 because of excess supply, and the tenure is, let's say, 4 years. So what will be the numbers? Number says your PV equals to negative 102, FB equals to 100, N is 4, and my PMT is equals to 0. Let's compute what is the yield we are generating. So yield is equals to, let's see, 102 negative 0, 100, 4, and PV. This is giving me a negative yield of 0.4938, negative yield of 0.4938%. It means yield can be, your implied yield can be negative in a very special scenario where you are having excess supply of money in the economy and you are investing in government securities for safety purpose only, then your return will be negative. So with this we are done with valuation and calculation of yield. On the coupon payment date, what will happen if we are going to do the valuation in between two coupon dates, that we will cover in the next part. Thank you.